Welcome to the MarketEdge Tech Talk with Will Paule and special guest David Blake. We're going to review the market conditions of the past week as well as longer-term trends from a technical perspective, take a closer look at the major indices, and to wrap it up, dig into a handful of individual stocks and ETFs requested by subscribers. If you have questions or want to submit a stock for next week's webinar, email us at support@marketedge.com.
Hello and welcome to the Tech Talk for Tuesday, May 17th, 2022. I'm your host, Will Paule, and I'm here with my co-host, David Blake. How are you doing today, David?
I'm doing good, Will. Thanks.
All right, let's start off with a look at what the market's been doing this past week with a look at the market letter.
All right. As has been the case, another volatile week, which ended up lower again. We did end up on a high note. However, at the close on Friday, the Dow Jones was down for its seventh straight week. That's the longest losing streak it's had in 10 years. And we had the NASDAQ and S&P 500 down for a sixth straight week. So, very bearish market. With the S&P 500 got down, I think, on Thursday. It was down about 19.6% from its high. So, we're in a bear market. I mean, that's what you get. You get these big swings in price when you have a bear market, that's near the bottom or at the top. So anyway, we had on Monday when we came in here, we had the 10-year T-bill rate got us up to 3.20, which will be resistance for investors to take a look at right now. That's 3.20%. It was the highest it's been in 10 years, I think. No, not in 10 years. I'm sorry. Since 2018. And then, as I said, the S&P 500 came down to we were down 19.6%. And on Monday, what basically sent stocks down was we had some weak trade data out of China that weighed on prices. It sent oil prices really, really low. I don't think they'll allow themselves to do that. But we had the energy sector went down 8.25%, and oil came down very close to $100 a barrel last week at one point. It did close at 110 a barrel. We've gotten that today. We've got a little bit of a bounce again. We're somewhere up. I think we're still. Let's see. Yeah, we're at 114 today. So oil prices really shooting out there again. A lot of that's because of the Ukraine and Russia war and Europe trying to cut off Russia's supply. We had came in on Wednesday. We had a higher than expected CPI number that triggered rate fears, and again we had another big sell-off. It was up. I think the NASDAQ fell 3% on Wednesday. We came in here at the open on Thursday. We had an April PPI showed wholesale prices had spiked 11% year over year. And that, again, we had the big drop on Thursday at the very open, basically. And then we came down to some of the retracement levels that we had talked about on the different averages. We got down right around there. The NASDAQ went below it. The S&P 500 went down right within about 5 or 6 points of it. The Dow didn't quite make it down there. But we started seeing buyers come in at that point. And we had a pretty strong rally off of that Thursday bottom, and it was on big volume, which was a plus for the market. We like to see that. Friday we had a little bit of a carry through. We had a big follow, big finish to the week. That was on a high note, and we actually, I think we had 2 days of advancing issues beating declining issues since something like early March. So that was the big plus. With that rally on Friday, it was the Dow Jones was able to snap a 6-day losing streak. We weren't even close to erasing the losses for the week, but it was still a strong bounce, especially off of the lows. I think the NASDAQ off of Thursday's low it actually had rallied something like 6.5%, something like that. So the technical condition of the market, despite Friday's bounce, it still remains weak. It's still bearish. All the technical indicators, for the most part, are negative. Some of the indexes not here with Monday a little bit today. We're starting to get some of the short-term MACD gauges, crossing over into bearish. Maybe I'd call it maybe neutral. The 14-day RSI is showing momentum is starting to pick up, but it's still somewhere around the 50 level. We're not seeing that crossing over the big positive momentum. I think it's still down about 40 or 42. The major average is still way below the 250-day moving average at this point. That still confirms the downtrend. NASDAQ, I think, on Thursday ended up being down something like 30%. So there's no ifs, ands, or buts about that being in a bear market. Again, like we did post those targets here a couple of weeks ago about some Fibonacci retracement levels, and I was going to say when we hit those, that we did get a bounce off of those, a strong bounce too. So that was good. The markets were oversold. I believe on Thursday at the close of the day, the MarketEdge S&P short range oscillator, the SRO, that's the one Jim Cramer talks about all the time. You can only buy on MarketEdge. That was at 8.25, and typically when that gets below a 7 or below, you're going to see institutional buyers step in, and we certainly saw that on Thursday. If we could calculate that during the day, it could have been 9.5 or 10. We were down so much at one point. So it closed at 8.25, and again, we saw buyers come in again on Friday for another big bounce, and then Monday they kind of churned around a little bit, consolidated some of those gains, and we're getting a nice bounce again today with stocks. I was going to say some of the other oversold readings that we get on Thursday at the close. We only had 19% of the stocks that we follow here at MarketEdge were trading above their 200-day moving average. That's a really low number. I would have to go back. I'm not going to right now, but let's see where we were in March of 2020. See, maybe more, because in this case, the 200-day move average has been falling for quite a while here. As far as the market internals go, they're still weak, but we did see a little bit of positive divergence. Just the fact that I said we had 2 days in a row where we had more advancing issues and declining issues. That's always good to see. You really can't say that's a big turn for the market, but we'll take any positive sign at this point. We did see investor sentiment get overly bearish and actually hit some extreme levels last week. I know the National Association of Active Investment Managers had fallen to only having 24.3% exposure. That's pretty extreme when you talk about the hedge funds only having about a quarter of their money exposed to stocks. That's low. Just let's see, 1, 2, 3, 4, 5 weeks ago, they were at 84%. Of course, then when we started talking about the rate hikes and going another maybe two percentage points, that certainly has had the institutions selling off. Volume was good on that drop. That's very good. We also had the the AAII. That's retail investors. They fell all the way down to 24.3. 50% of the retail guys are bearish. So that's still at a kind of an extreme level. We did get down to 16.4, which was a multi-year low 2 weeks ago, but so it's come up a little bit from that. But basically, this is some of the bearish that retail investors have been in a long time. So I wrapped up last week's letter talking about some things that still bother me and some analysts out there. Friday's rally was broad based. We had the Fed chair Powell coming out on, I think it was a Thursday or Friday, saying that they've got to really be careful. They may not be able to maneuver a soft landing for the economy, which is tough, especially with the fact of what they intend to, how much they want to raise rates. And I did some studies with off of Bloomberg, and one of the things that could derail this, despite if we get a bounce in here, is the fact that in the past, when you've had oil prices surging at the same time that the Federal Reserve was raising interest rates, you have been thrown into a recession. Now that occurred back in the mid 70s and the early 80s, and also in the early 90s. Of course, in the early 2000s with 9/11, that was a different cause, and then in the banking costs in 2008, that was again, it wasn't because of the rising rates. That was called, for the mortgage problems with the bank. So historically, when you have had these surging oil prices and higher rates, it hasn't turned out well for the economy, and we'll have to see that. Now, LPL also had a little article out where they noted that when midterm elections come up, you usually will have a little more of a volatility, and you also have a little bit of a rough market too. So besides the rate hikes coming up and surge oil, now we have the midterm elections going to be coming up here, and generally the market is prone to to a little bit of a sell-off because investors want to know who's going to win the elections. I think this year probably with the record, and I don't want to get into politically, but politics, but you're probably going to have the Republicans at least take over the Senate or the House. That'll change the outcome of maybe cause some more volatility in the market. However, LPL did note that once you get through the election period, or else going right into it, once the results are kind of known, you usually do have an end of the year rally off of an oversold level, and that's probably, again, looks good for the end of the year. So right now, momentum's not too good. There's not a lot of good things out there. Again, it was nice that we were able to identify some bottom areas where the market could put in a short-term bottom, and we've gotten a nice bounce off of that. We still have a lot of data to come out, but in this case, what I'm looking at as far as this bounce goes, when you draw in something called variable trend lines, VTLs, that are drawn off of just a short term when the market's bullish or bearish, and this rally has to go. Right now we're at about 40.75 on the S&P 500. If we look at the 20-day FLD, this market the S&P 500 needs to get above 4,100, maybe 4,120 on a closing basis for this rally to maybe get some more, have some more strength to it. If it fails to get through that, then perhaps last week's Thursday low may not be the bottom here. We may have another week or two before we bottom out on this thing. But if the next day or two we can get above 4,100, 4,120, that area on a closing basis, and all the other indexes again come up, are able to hold on to the gains, then we might be able to rally maybe here for another couple of weeks. But at this stage, if we don't get through that, I would look for at least a retest of those Fibonacci targets that we talked about last week. And we're getting closer now to within 2 weeks or so, 2-3 weeks of the next rate hike. That's going to keep a little bit of pressure on the market. I don't think anybody wants to jump in here and say, hey, that was a good looking bottom there. We had nice volume. Jump in, buy and hold, and then get slammed with the Federal Reserve raising rates another half point, and then them saying that they may have to go even a half to 3/4 of July if inflation doesn't slow down. So, and if you're trading, when you get down to that Fibonacci thing, you can take a look at that. Up around 4,100, 4,120 on S&P 500, you may think about possibly, lightening up if you're just trading some stocks or whatever, and take some short-term profits and see if we're able to break through that resistance level, or whether we're going to come down and possibly even make another low.
All right. So the market remains volatile, but we are seeing the VIX pull back, which is always a good sign. Last week, we talked about possible downside targets for the major averages based on Fibonacci retracement levels. And as you pointed out in the weekly market letter, they seem to find support there on Thursday and bounced off those levels with more gains today. Is this the buying opportunity that investors are looking for, or are we more in a waiting period still?
This is what I would consider a trading market at this point. When you get these big sell-offs, maybe you look at the XLRE, you get it down around 7 or something like that, and you can buy. You're probably going to get some short-term buys. In a bear market, even in a bull market, especially a bear market, you are susceptible to some wild swings in the market, and by that I mean well, you can get a 4 or 5%, 6% spike in off of a low, and I think that we're in that kind of right now. Like I say, you need to get this S&P 500 to break the downward the variable trend lines for it to cross above those. You need some of these lines of demarcation to get for it to cross above that. And even with today's rally, we did not get there. In fact, we got up to around 40.78, 40.80, and we didn't even get to the 4100, which is what I would consider the resistance here. And we've pulled back. We're at 40.50 right now. So until you see that, until we get through that, I would just consider if you're looking at some of these stocks, you buy them and you trade them. You get yourself a 15-20% move in a stock or whatever, and you go ahead and try to take it. You look at even like Home Depot today after great earnings. They came out and they're back up positive right now, but it was up about 8-10% earlier, and now we're only up $4 or something like that. And if you miss, God forbid, Walmart wasn't really their fault. It was supply chain issues. They came in short. This is the worst day Walmart's had in 20 years. It's down 11.6%. And they just had, if you follow that chart, they just had a multi-year breakout going into earnings. It looked like that traders and investors were, especially institutional buyers, they saw that big breakout of the charts. People were expecting Walmart to have a good market. Now, if they had just broken even for the day, obviously the Dow Jones would have done much better. But we also have some earnings coming out with Target, I think tomorrow or tomorrow night. You have TJ Maxx coming out. More retail things coming out, and when you're starting to slow down, kind of go into a recession, you do start to see some slowing numbers in retail stocks. It's people start, instead of buying on credit, all of a sudden they go, whoa, if I buy this TV instead of 0% interest, all of a sudden I'm gonna have to pay 6 or 7 or 8%, something like that. They don't buy as much. They've had a lot of pent up demand, which has really helped out the retail stocks, especially. And I think you're going to see some of that pull back here as rates stay up. And the wild card, of course, is if oil stays up this where it is, up to 115 or 120, more than that, that's not going to be good. And again, if we come out here on June and Powell raises rates 50 cents, and he says, so far we're not having any effect at all on inflation. We may have to, go at least maybe 3 quarters in July. That would certainly be bearish for the market overall, because the market, although you invest for longer term, it's rather short-sighted. If he would say something like that, you would probably have a pretty deep sell-off in the market. And I don't think it's prudent to wait for to buy now and hope that he doesn't say something that they're not having the effect they want on inflation. They used to say hope is not a good investment philosophy. When you buy something, you hope it goes up. That's not how you invest in the market. So at this stage, I would use big sell. You get a day in here, maybe tomorrow or something like that. You see the market down 700 points. The XLRE jumps up to 7.5 or 8. Maybe you look at something that the chart doesn't look all that bad. You look kind of maybe some of these oil stocks or whatever, and you can buy something and see if you can get a bounce where you can maybe lock in 15-20% on a day. Like the airlines are having a great day today, and part of that is that United came out today and they raised their estimates, and they said, hey, we're booked for the summer. The pent up demand has that, it's there, but is that going to how much is that going to carry over into the fall? And the market usually looks at a couple of months ahead of time. People that got this bounce may be thinking, well, but we're not going to be traveling as much maybe in the fall. So this stage, I would just use the market to trade oversold issues, and keep an eye on that 4100 to 4120 on the S&P 500. If we do crack through that, I think you're good. If we can't crack through that, we may have another leg that takes it that maybe goes down, maybe at least tests last Thursday's low. I don't know, but you want to keep an eye on that range in there. And if we do take out last Thursday's low, we obviously have a little bit more selling to go over on the near term.
All right. Well, that's all we have for you today. Remember, if you have a question you'd like answered in the next Tuesday Tech Talk, you can email it in support@marketedge.com or ask one of our live chat representatives to pass your question along to us for the next Tuesday Tech Talk. Thank you for tuning in, and we'll see you next week.